6 categories of stocks. This is the second part of the video. If you haven't watched part 1, check the link in the description. The video is all about checklist as per Mr. Peter Lynch before investing in stocks. And in this video, we are going to learn about the 6 different categories of stocks. All companies, whether publicly traded, unlisted or privately held, can be classified into one of these 6 categories. So learning them will help you understand where the business is headed in the future. Hello everyone, I'm Rakshit Pai, and in this video we'll learn the 6 categories of stocks. Four phases of business life cycle. Understanding the different business phases is important before we get into the categories of stocks.
That's right.
So here are the 4 stages of business. The first phase is the startup phase. Startup is a new bud. It begins with an idea that later grows into full-fledged business. Startups have high mortality rate. So in general, 90 to 95% of startups fail within the first 3 to 5 years of operation. For example, companies such as Zerodha, Zoho were the startups that became successful. I even consider my venture, that is to say my website, YouTube and such, to be my startups.
Oh yeah. Wow. Yeah. Okay.
The second phase is growth phase. When a company gets past its startup difficulties, it gets stronger and starts to lead its industry. Such companies enter the growth phase. Here we see the companies to have aggressive growth in revenue and market share. The third phase is mature phase. Here the company has command over its market. They have consistent cash flows, a strong customer base and a dependable business model. And the fourth phase, that is decline. Those companies that can't keep up with the market demand will start losing out. So comes the decline phase. Here the company will lose to its competitors and in due time will die a slow death. So now we know the 4 phases of a company. Let's get into the 6 different categories of company. Number 1, slow growers. Slow growers are those large blue chip companies that have matured enough to cater to their market, that is entire market. These companies were once the fast growers and were the torch bearers in the industry. They were once the most favorite hot stocks. But now that they have grown into this enormous size with no room for expansion, they are slowing down. Such companies we call slow growers. Slow. In order to identify slow growers, ask these questions. Is it a large cap blue chip company? Is the company's revenue growth below the industry average? Is the growth in single digit not because of inefficiency but because of saturated market? Is the company's product a household name? Do most mutual funds and other large institutions prefer to own them? Does this company pay out dividend, and if so, is the dividend payout consistent and growing over time? Is the company valued at a high PE multiple? If the answer to all or any of these questions is a yes, then you may be looking at a slow grower. Number 2, stalwarts. Stalwarts means loyal or someone who is reliable and hardworking.
Most important thing in business is honesty, integrity, hard work.
In this case, a stalwart is a company that has experienced strong growth such as double digits and is the type of company that continues to grow and will become slow grower in the future. So any mid and large cap companies that have high growth amongst its peers, something that's above the industry average and definitely above the country's GDP growth rate, can be put into this category. In order to identify stalwart, ask these questions. Is the company one of the top players in the industry? Is the top line growth rate in double digits? Is the company the fast grower in its industry? Can the company cater to the market if there are no other competitors? Is the growth in the earnings increasing steadily over a 5 to 10 years period? Does this company pay out dividends, and if so, is the dividend payout consistent and growing over time? If the answer to all or any of these questions is a yes, then you are looking at a stalwart. Number 3, cyclicals. Cyclical businesses are those that have cyclical product demand. You might have heard the term, a company's share price is slave to its earnings. This phrase is true when you look at it from a long-term perspective. Also, cyclical businesses are highly dependent on the economy, in the sense that these companies will tend to react as the economy does. If the economy is strong and flourishing, so is the company. In order to identify a cyclical, ask these questions. Is the company's earnings dependent on the economy at large? Is the quarterly earnings volatile such that certain quarters give strong earnings while the rest of the month gives dull figures? Is the company dependent on any raw material as its base product? Will a commodity price drastically affect the company's bottom line? Is the company's stock price volatile and showing a zigzag pattern? If the answer to all or any of these questions is a yes, then you are looking at a cyclical. Number 4. Fast growers. As opposed to the slow growers, a fast growers, as the name suggests, gives double-digit revenue growth. Strong double-digit growth can be provided by mid and small cap companies that are performing better than their competitors. We see that these companies are growing at a rapid pace with annual CAGR ranging from 20 to 30%. As a result, we can classify them as having the potential to become a multi-bagger.
Let's see what you got.
You smell that? What is that?
What?
What's that smell?
The cologne?
No.
Opportunity.
No. Money.
Okay.
I smell money.
Okay.
In order to identify a fast grower, ask these questions. Is the company's major revenue generating business segment growing by double digits? Does the company have a moat that's directly traceable to its operating efficiency? Is the company's revenue and margin growth the highest in the industry? Is the growth consistent over at least a 3-year period? Is the company not owned by major institutions? The company is not yet in the mainstream. Is there room for growth in the business, and if so, is the capex spent by the management in this regards is high? If the answer to all or any of these questions is a yes, then you may be looking at a fast grower. Number 5. Turnaround. Turnaround is something that's not a fast grower but also not a slow grower either. It's something in the between. Basically, turnarounds are those businesses that haven't lived up to their expectations, but due to certain changes in the business such as new management, new business segments, etc., there's new hope.
Hope. Let me tell you something, my friend. Hope is a dangerous thing. Hope can drive a man insane.
And that new hope could either make or break this company. A turnaround can be your best investment, but it also has the potential or probability of becoming your worst. Anything can happen to the company in this stage. In order to identify a turnaround, ask these questions. Is the company in financial trouble? Is there something going on to revive this situation? Is there talk of mergers, acquisitions and takeovers going around? Does the company have the financial means to survive the current difficulties? Is there a new management or a new business segment? Basically, is there anything new that could revamp the company? Is the company's product or service getting traction in the market? If the answer to all or any of these questions is a yes, then you may be looking at a turnaround. Number 6. Asset plays. Asset plays, as the name implies, are areas in which company has significant assets on its balance sheet. When we refer to asset plays, we mean assets that have always been present on the books of accounts, but that the market has overlooked or undervalued until recently. Asset plays are where you buy a company's shares purely based on its assets. For example, property, the loan book, goodwill, cash and bank positions, and investments, etc. In order to identify an asset play, ask these questions. When you go through the company's books, do you feel that the quantifiable asset value is not priced right by the market? Is the company in business for multiple decades and being neglected by broad market participants? Does the company have major tangible assets on its books? Is the business in manufacturing, which has a high entry barrier? Is the company a public sector undertaking, or was it part of it anytime in the past? If the answer to all or any of these questions is a yes, then you may be looking at a asset play. Conclusion. I can't stress enough the importance of identifying these categories, putting your company into one of them and looking at it from a different perspective. Each company behaves in a certain manner when it is in a certain business cycle, or in this case, a certain category of growth. So the next time you do some research on any company, just take a step back and try to put your company into any of these categories. You learn a lot about the business. This is one of many aspects, and for knowledge we must thank Sir Peter Lynch. I hope the video was informative. Thank you for watching.